Unless you've been living under a rock for the past few months, you are likely aware that the price of Bitcoin has soared. Again. At the time of recording this video, Bitcoin is hovering at about $67,000 after having risen to an all-time high of about $69,000 a couple of days earlier. That is a 57% increase since the beginning of 2024 and an astounding 153% increase over the last 6 months. Now for Bitcoin, this isn't anything new. In fact, Bitcoin is known, rather infamous, for behaving like this. In 2017, for instance, Bitcoin rose from $1,000 at the start of the year to an astounding $19,000 by mid-December. And similarly, after dropping to about $7,000 at the start of 2020, Bitcoin again rose more than 400% to almost $30,000 by the end of 2020, and then another 100% by April 2021 to surpass the $60,000 mark before it came crashing down. So it does seem like history is repeating itself. What makes this recent rally somewhat different, though, is that it is supported by major investment companies like BlackRock and Fidelity, which at the beginning of 2024 got regulatory approval to start offering spot Bitcoin ETFs to retail investors, which is a pretty significant development. Because see, before these ETFs, if you wanted to invest in Bitcoin, you'd have to set up a digital wallet on platforms like Coinbase or Binance or some obscure exchange, which is, well, A, just very different from how regular investing works, and B, kind of risky, especially if you are creating a digital wallet on an exchange that you don't know anything about. I mean, who's to say that people operating the exchange just take your money and run? Which has happened. Or if the exchange goes bankrupt, which has also happened. Anyone remember FTX? But Bitcoin ETFs work differently, because here, well-established companies like BlackRock and Fidelity are the ones that hold the Bitcoin in their digital wallets, and then they issue shares to people like you and me to buy and sell on an exchange, where these shares derive their value from the underlying asset, in this case, Bitcoin. So, if the price of Bitcoin goes up, the price of the shares goes up. And similarly, if the price of Bitcoin goes down, the price of shares goes down. As you can imagine, Bitcoin ETFs make it significantly easier for regular investors to gain exposure to movements in the prices of Bitcoin, which means that a lot of people who were initially on the fence are now willing, if not eager, to buy shares in these ETFs. And to cater to this investor appetite, US finance giants like BlackRock, like Fidelity, have poured billions of dollars into buying Bitcoins for their ETFs. And this increased demand, combined with the fact that there's only 21 million Bitcoins in supply, is a big part of the reason why the price of Bitcoin has recently shot up. To give you some sense of this increased demand, in a span of just 3 months, the total assets in the top 10 US Bitcoin funds have swelled to $50 billion, with BlackRock's ETF called iShares Bitcoin Trust bringing in $10 billion in assets. It is the fastest a new ETF has reached that milestone. Similarly, Fidelity's Bitcoin ETF now has close to $6 billion in assets and is already its third largest ETF. And so now the million-dollar question is, should you invest in any of these Bitcoin ETFs? All right, I'm going to be honest with you. I'm not really in a position to give you financial advice, but here is my humble opinion. Be very, very careful buying shares in these ETFs. And I know it's neither here nor there, but hear me out. Look, the thing is that you either believe in Bitcoin or you don't. You either believe that it's the future or you don't. You can either handle huge price swings or you can't. You can either afford to speculate or you can't. One way or another, Bitcoin is either for you or it isn't. The Bitcoin camp is just as divided as it has always been, and I don't intend to regurgitate any of the arguments for why Bitcoin will go to $1 million or why it will plummet to zero. What I do want to tell you is that the launch of Bitcoin ETFs in itself says nothing, absolutely nothing about the legitimacy or the fundamental value of Bitcoin. Bitcoin is just as valuable as it has always been. Worth a whole lot if you are on one side of the camp, or worth nothing if you're on the other side of the camp. That hasn't changed. See, what you really need to understand is that at the end of the day, Bitcoin ETFs are just a financial product. In fact, they are an example of what are called thematic ETFs, which, as the name suggests, are ETFs that focus on specific trends or themes like sustainability, cannabis, vegan products, trade wars, work from home, artificial intelligence, Bitcoin. And research shows that investment companies usually create these kind of ETFs merely to cater to investor demand for popular investment themes. It doesn't really matter how rational or irrational that demand is. As long as there is demand, investors are willing to pay a high price to purchase shares in these ETFs. And sure enough, thematic ETFs charge investors considerably higher fees compared to other ETFs. Now you're saying, well, I'm fine paying the high fees as long as the returns are there, as long as I'm buying a superior product. But that is just it. Research shows that these thematic ETFs typically come about when investor demand is already high, and hence the underlying asset is already somewhat overvalued, which is why thematic ETFs on average make for terrible investment returns net of fees. So one specific recent research paper that I want to tell you about, which really drives home this point, is by Professor Ben David and his co-authors. Ben David is a professor of finance at Ohio State University, and this paper, now published in Review of Financial Studies, which is a top-tier journal, is called Competition for Attention in the ETF Space. And in this paper, the authors present some fascinating findings about the ETF industry. Now, I won't go into the details of each and everything that they talk about, but I do want to show you one set of graphs from the paper, which shows the performance of the ETF underlying indices for ETFs focused on specific industries, as well as ETFs focused on specific themes, both before and after the launch of the ETF. The authors make use of data between 2000 and 2019, and what they essentially show is that before the inception of such ETFs, the underlying indices experience a price run-up. But once the ETF is launched, the indices underperform. And so they use this and other supporting evidence to argue, and I selectively quote, that newly launched specialized ETFs hold portfolios of securities in attention-grabbing segments of the market. These are stocks that experienced recent price run-ups, had recent media exposure, especially positive exposure, and displayed general traits that have been previously shown to indicate overvaluation. Moreover, the investor clientele of specialized ETFs has a greater fraction of retail investors, like you and me, who are typically considered less sophisticated and therefore more prone to holding incorrect beliefs. We find additional evidence indicating that specialized ETFs target investors' extrapolative beliefs, that is, the tendency to expect recent performance of an asset to continue into the future. And so our overall results suggest that specialized ETFs mainly compete for the attention of performance-chasing investors. So here's the thing, my dear friends. Bitcoin ETFs are specialized thematic ETFs. And the point that I'm trying to make is a very simple one. Bitcoin ETFs don't make Bitcoin any safer or any more legitimate per se. I can't tell you whether you will make money buying shares in Bitcoin ETFs, but I know who will make money, firms like BlackRock and Fidelity, who are selling you these ETFs. And look, there's nothing wrong with that, of course, but you'd be remiss to not acknowledge this profit motive being at least one of the reasons why these ETFs are here. And rest assured, you will be seeing more crypto-themed ETFs in the near future because there's a lot of investor appetite to cater to, especially that of retail investors. If you'd like to read the paper by Ben David and his co-authors, which I highly recommend, by the way, the link is in the description below. All the best in your investment journey. This is Professor Ikram. Thanks for tuning in. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning!